Good morning, students. Today we will begin accounts from lesson 2. Today I'll explain the basic accounting terms. These words are very much new for you people since this is these words. This is the first time you are seeing these words. And these are the terms which we will be using most of the time while doing accounts. So first of all, I welcome you all in class 11 and congratulate you for successfully passing out class 10th. And also, I would wish best of luck for your new sessions, new terms. Although due to COVID-19, we are unable to meet with each other physically, though we will try to study through this video. So, to begin with this class 11th accounts, first of all we see what are the accounting terms. These are the new words which will be used in accounts, and we will let us learn what does these different words means. First of all, here in this point wise I have written few words, more I will write. So first of all, first word is business transactions. Now with business, with the word business, we know that business is such where such activities which we do to earn the profit. That means these transactions or these activities are related to money. That means these activities, through these activities, we earn our livelihood. So, livelihood. So, this is business transactions. That means, I'll give an example. Often we go to the market and then we buy goods. Against that, we give the money. Similarly, this is the pen. If I want to buy this pen from the shop, I will take this pen and I'll give money. That means give and take policy. But here in give and take policy, money is used as a medium of transfer of the object. That means one object changes hand with through the medium of money. So if we do any activities which is related to earning profit and it is financial transactions, financials give and take things, then it is business transactions. Next is accounts. Now accounts, I'll give you a very brief explanation. It is generally in the form of T shape. This is T, how we write. So it is formed in these shapes where there is a debit side and there is a credit side. Now various types of transactions, activities, goes on in the business, and every activities is different in its nature and characteristics. So accordingly we enter it. Later on we will learn what are the rules. There are types of accounts and then rules are related to given for every accounts, and following those things we will learn what are the entries we need to enter it into the debit side and what are the entries we need to enter it into the credit side. So this in this format, we keep the record of the business transactions. So this is what it is known as accounts. Next is capital. Now what is capital? Capital can be in the form of, I'll tell first, form of cash, assets and goods. So this capital, what it means? It means the investment at the very beginning of the business. When the business starts, the investment is done by the owner, or we call him as a proprietor or owner who invests capital. And you have also come across many a times when we visit the market, we come across the new business openings, and we see people when they are about to start, before they start their business, they paint the shops. They take the shop in rent. Either they take it in rent or they purchase it. Then they produce the furnitures. They buy the goods and put them in the showcase. They build the counters. They build the cash box. All these things they do at the beginning before they start their business. And then once they complete the internal show of the business, or the presentation of the goods through the presentations of goods in the shelf, or we can say it in the furniture showcase, then once it is completed, then they begin their business. And they give, even some business people, they give us the invitation card on the grand opening of the shop or the mall, and these are the things. So before they start the mall or shop, they arrange everything. They arrange the furnitures, they arrange the goods, they try to make the shop attractive, beautiful. For all these things, they'll spend a lot of money. So ultimately, when the business is ready, we will not find everything in the cash, but we find cash as well as furnitures, as well as electrical expenses, goods, all these things you can see inside the shop. So all these things that the owner put into the business to start a business is called capital. So capital can be in the form of cash, it can be a form of assets. Now assets are, we call it in Hindi, sampatti. Sampatti means the things which we keep, we buy, we purchase, and we use it for our benefits. Next is goods. Now these are the goods, these are also assets, but these we produce with the point of view of reselling it and earning profit. So all these things together that the owner introduces into the business is known as capital. Now capital can be divided into three parts. These are the three parts of the capital. One is fixed capital. Now what is fixed capital? When owner buys the fixed assets and whatever money he spends into the fixed assets of the shops, those are called, those total amount that he has invested is known as fixed capital. Next is floating capital. Now purchase with the point of view of resale. Now whatever he buys, everything he doesn't keep it for a long time. Few think these fixed assets, these fixed goods that he introduces into the business, he uses it for long period of time. But few goods are there the goods, that a few goods are there which he buys it and keeps it into the shop with a point of view to resell it and then earn profit. That is known as floating capital. Now this is floating capital. Next is working capital. If you see in the business, you might have come across that businessman keeps some money in his cash counter. In his cash counter, he keeps his money for daily transactions, daily basis, that expenses. He does little small direct or indirect expenses almost every day. For that he needs some cash also, and he also keeps his cash to give the return and all these things, expenses he does. So whatever cash he keeps in his cash counter for payment of direct and indirect expenses are known as working capital. So I think you have understood there are three parts in this. These three parts altogether form the capital, total capital of the owner. Fixed capital, the money which he spends to acquire the fixed assets like furniture, electrical appliances, cash counters and other presentation counters. So all these things are included in the fixed capital. Total up into fixed capital. Next is floating capital. Floating capital means the goods which he purchased, those are also assets, but he purchased it with a point of view to resell it and earn profit. So those are known as floating capital. Next is working capital. In the business, like in our home also, every day we spend some money for buying small little things. But in business, if we see, they keep cash in their cash counter for payment of direct and indirect expenses which they need to incur every day, which they need to do every day. Next, let us come to the fourth point, that is drawings. Now what is drawings? Drawings can be in the form of cash or goods. Now drawings means, let us first see what is drawings. An owner, when he starts his business, he puts all his cash, his everything into the business. Now business is the only source of income for a businessman. Now if he wants to spend some money, suppose a businessman, he opened up his shop in the market, and whatever money he had for the business, he had put into this business. Now if he needs some money to for the home expenses or home requirement, then where from he will get the money? Because he has already put whatever money he had into the business. So he will not, where from he will get this money? So he has to, since the business is his only source of income, so what he will do, he will withdraw money from the business. He will withdraw money from the business as per his requirement. Whatever amount he needs it, that much he will draw from the business, and this money which he has withdrawn or goods, even he may withdraw the goods from the business. Suppose a businessman, he started a grocery shop and he needs certain grocery items like dal or mustard oil or salt, something like that. If he needs at home, he won't go to any other business and buy it. What he will do, he will take it out from his own business for his home. So he may withdraw money also, he may withdraw goods also according to his requirement. So these both money or goods, whatever he has withdrawn from the business, is known as drawings. Next, let us come to liabilities. Now what is liabilities? Liabilities means in Hindi we can say it udhari. Udhar, every one of you knows udhari, what it is. So udhari is liabilities. Means you are taking some money you are taking money or things on credit or on loan basis. If you take money on the loan basis, that means you are liable to repay the amount from the person whom you have taken. So that is your liability. Then another example I'll give. Suppose you have taken to open up your business. You have purchased few goods on cash and the few amount of goods in credit. Now, when you have purchased the goods in the credit, you are liable to pay off the bills that has arisen. So this goods that you have purchased in credit and you didn't pay for it, that gives rise to the liabilities. Now liabilities are also three different types. There are long-term or fixed liabilities, current liabilities and contingent liabilities. So what is fixed liabilities? The fixed liabilities are long-term liabilities. Long-term liabilities means these are such type of loan which you have taken for a very longer period of time, that is more than 1 year. More than 1 year. It can be 10 years, it can be 15 years, 20 years, 8 years, 7 years, whatever it is. These are called long-term loans or long-term liability. The most long-term liability of the business is capital. Capital is the most long-term fixed liability of the business. Fixed liability of business. Why it is called fixed liability? Capital is called the liability of the business because before that I'll explain you principle, that is principle of entity. What the principle of entity says that this business and the proprietor, these are two different individuals. In accounts, this business, as we know that till class 10 you might have studied that we regard only living things as a person or living things as a person, but in accounts non-living things also becomes, we treat them as a person. So for example, if you look around in the market, you will see that most of the business centers has a different name. Like we people, we have different names. So similarly in the business centers also, if you visit the market, you will see that most of the organizations or business centers, they have a different names. Why we put their names? Because we regard them as an individual. So here business and proprietor, they are two different individuals, and it is treated as that the proprietor is treated as a person from whom the business has the proprietor, whatever he invests, generally he invests money into the business. With what motive? His motive is to earn profit. His motive is to earn profit. With this motive, he invests the money into the business, and business is liable to return the money once it is closed. So here you can understand that business, with the business point of view, this money that the proprietor invested is liability of the business, because business needs to return the money that proprietor invested into it. So that is why this capital is long-term liability for the business, because as long as business continues, the capital is there in the business and it is the liability of the business. So capital is the most long-term or fixed liabilities of the business. Next is current liabilities. Current liabilities are those liabilities that we need to pay off within a period of 1 year. That means suppose you have taken bank overdraft. Bank overdraft, I will explain what is bank overdraft. If you see in the book, this word is there. Now what does it mean? First of all, let us know what is bank overdraft. Suppose a businessman has a very good relationship with the bank. So let us take this example only. This this business has opened an account with a, say, SBI, State Bank of India, and this account is a current account. For we public, it is saving account where whatever we save money we deposit into saving account. But business, for business purpose, we need to open up a current account. So this is almost like an saving account that we will come later on, and I'll explain about the difference between the saving account and the current account. So let us understand that we people, we open up saving account for ourselves, and for business you need to open up current account, and this business he has created a current account in the SBI bank. Now suppose in his current account there is 10,000 amount. An amount of 10,000 is there in his current account as a balance. That means in his account there is only 10,000. And this businessman, he has a very good relationship with the SBI. So when there is a very good relationship between the customer and the bank, the bank provides certain facilities. So what is this facility? This is nothing but bank overdraft. Now suppose I'll take an example, you will understand better. Suppose the businessman, he needs to pay someone 12,000 rupees. For example, he needs to pay 12,000 rupees, and he doesn't have the idea of what is there in his account balance. Suppose he forgot. He might have forgot because businessman is very busy with his business. So he forgot that in his account there is a balance of 10,000, but he issued a check of 12,000. Now what the bank will do? Since he has a very good relationship with the bank will not generally, this type of checks gets bounced or it gets cancelled by the bank, since he doesn't have sufficient amount in the bank account. So what happens, due to the very good relationship, the SBI, the bank manager will inform the business owner, proprietor, that you have a account balance of 10,000 and you issued 12,000. He will not bounce the check, he will not cancel the check. Instead, the bank, what he will do, he will pay off the 12,000. Instead of, he will not cancel the check. He will clear the payment of 12,000, and before clearing that amount of 12,000, he will inform the business that you have 10,000 in your account and you have issued 12,000 check. So 2,000 more we are paying from our side, and you need to pay off the amount within certain period of time that they will provide. So this facility is known as overdraft. Why it is overdraft? That means why it is overdraft? Because you have 10,000 in your account and you are paid 12,000. That means how much extra the bank paid from their side? That is 2,000 extra they paid from their side. And this 2,000 that they paid extra is known as bank overdraft, and this will be written as a credit. In your account. So this is what it is known as bank overdraft. Generally, bank overdraft facility is given for a period of less than 1 year. So this is known as current liabilities. Next is, what is contingent liabilities? Contingent liabilities are those liabilities which arises due to which may arise or may not arise. That means it is uncertain. Contingent liabilities are uncertain. So it may arise also and it may not arise also. For this, I'll take an example. Suppose let me take an example of court case. Let us take an example that this is an electronic shop. And they are selling TVs of various brand. Suppose one customer, he came to purchase a TV sets. Now, when he purchased from the shop, generally what the shop shop attendant will do, he will put on the TV and he will show that everything, and he will explain the specifications of the TV, and then he will sell it to the customer. And similarly, it happened here also. The electric shop, he sold the goods to the customer. Now, customer, he took the TV and went home. And he started using it, watching the TV. He started watching the TV. Suppose after 2 days, for example, this is just an incident, imaginary incident. After 2 days, the TV, something went wrong in the TV, and he find it disturbed. He find it disturbed. So what he did, he will bring this TV back to the shop, and he will put a complaint in the shop that within 2 days my TV something gone wrong and with my TV, and it is not working. Now, in this situation, there could be a clash. There could be a clash between this electric shop and the customer. There could be argument between the electric shop and the customers. Now, after arguments, the customer, he went to the court and he filed a case against the electric shop. He will go to the consumer court and he will file the case and against electronic shop. Now, in case of this business, since we are talking about business, so for business, this is the situation which is uncertain. Now, in this court case, this electric shop, he may win the case or he may lose the case. But if he wins the case, he will not be in loss. He is not going to lose anything. But if he loses the case, then he has to pay compensation to the customer. So now this, if he needs to pay compensation to the customer, that means it is his liability. And he needs to create a reserve for that. So reserve that I will explain you later when it comes. So he has now he is in such a position where he doesn't know whether he needs to pay the compensation or he need not pay any compensation. So this is the situation where the liability is uncertain. Liability is not certain whether compensation is a liability if you are supposed to pay to the customer, but it is not sure whether he will be told to pay or he will not be asked to pay the money. So this is what it is, contingent liabilities. And next we will continue in the remaining terms we will continue in the next video. Thank you.